personal finance practice problem using OneNote. Flexible personal budget. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, we're over here in the icon on the left-hand side, Practice Problems tab, down in the 2190 Flexible Personal Budget tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're going to put together a basic type of budget, both in the format of a standard format, and then convert it to a flexible type of budget, which is going to be pulling some of the concepts you might see if you worked with managerial type of accounting for businesses typically that produce things. And it can be useful then to break out the expenses not simply by category, which is the normal way we break things out, meaning it's something we paid for the telephone, so it's a telephone expense, the utilities expense, it's the clothing expense, the food and entertainment expense, but rather possibly by behavior of the costs, meaning how do the costs go up and down with relation to sales. Now, this normally comes from a situation where you make things. So if you have, say, a burger shop or something like that, or a burger cart that you had out there, you're selling burgers, then you might think about how many sales you might have, and then you can break down your costs from variable to fixed costs. The variable costs then going up, things like meat, buns, and whatnot, as you sell burgers. So the more burgers you sell, you can break down the variable costs per burger so that you can actually figure out how much you're getting per burger after variable costs, and then take a look at how many burgers you would need to sell to cover the fixed costs, which would be like the rent of the cart itself. So it's really useful. It could be called break-even type of analysis for something like a sale, whenever you're selling something like that. It can be the same kind of concept can be applied on the personal side of things, although you don't have that direct relationship. In other words, as your income goes up, you're not selling actual units, so it's not like your expenses will go up as a direct relationship to the units of sales that you have as it would if you sold burgers in a business. But generally, as your income goes up, some of your expenses will typically go up, and you can see the ones that you have more control over are the ones that might go up as well. So you might then think about it in terms of like entertainment. That's something that usually for most people goes up as their income goes up. And so you might also think about it about those things that you have control over, the things you don't have control over. Fixed costs, like the rent, are things you don't have control over. So you want to kind of, when you're on a month-by-month decision-making process, kind of pull out the rent, because it should be the same from month to month. And until you actually sign the lease again, you don't have any control over it. And when you get to your budgeting, you want to judge yourself, your performance on the things that you have, control over. So that's going to be the general idea. So let's first do kind of a normal kind of budgeting process. We're gonna break out just a short budget for an example of this. We got the monthly income. We're gonna say $6,000. We got the saving. We're going to save 25% of it. So we're going to say that we're committed to saving 25% of it. Remember, when you save a percentage, that might be useful to do actually, directly. Have before you even see the money in your checking account, take out 25%. That way you're kind of committed to that, and it would be similar to kind of like a fixed cost if you were to do that. And then the fixed expenses, which I would say is something like the rent, would be the $1,500. And then we have the variable expenses, which we're going to say are 40%, which we're going to say is basically everything else, right? Most things are going to be variable. Now, notice when you think about this kind of breakout, one of the problems, of course, is that you then have to go in and categorize all your expenses as either fixed or variable. And that can be a difficult thing to do because a lot of your expenses you might consider to be in the mixed category. In other words, have a variable and fixed portion to them. So like utilities and stuff like that, you might say, hey, there's a baseline that I need to have just to live. So that's basically fixed. And then there's a variable portion over and above that. So if you were to get more complex on this type of calculation, you might break out something like utilities as having a fixed and variable portion, the variable portion being the part that you have control over, the fixed portion being you might allocate as fixed. That gets a little bit more complex because now you're breaking out expenses into fixed and variable portions and whatnot. So you might do it an easier way and just try to label the things that are completely fixed, which might include like the rent and might include like insurance or something like that, which you know exactly what you're going to be paying and whatnot. And it is what it is. You can't really do anything about it. And then everything else, which is mixed and variable, where at least you have some control over it, you might then break out into the variable category. Let's first think about this without breaking it out into fixed and variable, and just think about the inflows. The inflows we're saying are $6,000 on the inflow. Outflows we're going to say are the monthly savings, and we calculated that as just taking the 25% of the 6,000 times 0.25, and we got the 1,500 on the savings, noting that the savings, when we're thinking about it in this format, is something that's coming out of our earnings in that we can't spend it, but from an accounting standpoint, it's going into, of course, an asset account on the balance sheet, which would be our savings account. So we're going to decrease it here. We got the fixed expenses. That's the 1,500. We're imagining being like the rent, being the most common kind of fixed expense. You might put other things up there as well, the things that are going to be standardized from month to month. Anything that's a subscription kind of thing, you might say, hey, I'm not changing that. I'm not getting rid of it. I need it. And so it is what it is. You might then categorize it as fixed. And then we have all the variable, which we're going to say is going to be the 6,000 times the 0.4, 2,400. So if we were to sum up our expenses, the 1.5, the 1.5, the 2.4, that comes out to the 5,400. And if that was our budget categories, then we could take the 6,000 minus the 5,400 and get the 600, the remaining amount that we could then do something with, either increase in our checking account or put into a savings account or so on at that point in time. So clearly, if you were to break this out in more detail, you wouldn't just simply have fixed expenses. You'd have fixed expenses and then a subcategory of things like rent and so on, which we might do in another practice problem to show the detail. And then the variable expenses would be all the different layout of variable expenses, which in total might be 40%, but you might come into a more complex series of percentages for each variable expense, which might show another example of in a future problem to help you out with the budgeting and your budgeting situation. Let's do it again, this time breaking out on a little bit differently. Same numbers, but we'll break it out differently. So we got the flexible spending, and we're going to say that's going to be the 6,000, and then I'm going to pull out the fixed 1,500 up top as fixed, and I'm going to come up to a subcategory, which is the total flexible spending income, meaning this 6,000 is going to be our income. We're going to have to pay the rent. There's nothing I can do about the fact that we're paying the rent in essence, which will leave us with the 4,500, which we have some control over, at least more control. So our other expenses, we have a little bit more control over in this sense. That's why we have this subtotal. And then we got the variable costs that we can break out, which may include the monthly savings. Note that you might include the monthly savings up top if you think about it as a fixed cost, or if you think about it as something that could change based out of your monthly total, you might put it down here. It depends how you want to categorize these two items. And then your variable expenses, which would be all your other expenses, which in this thinking or this thought process means these are the expenses you have some control over. In other words, if you were to make a budget from month to month, these fixed expenses like the rent, you would think would not vary from budget versus actual from month to month, because you know exactly what they're going to be, and they're going to be that because that's how much you owe for rent. Whereas these down here are the ones that you have control over. So when you vary the budget, compare what you actually did, performance versus the budget, that's where the differences will be, and that's where you can make changes. That's where your behavior can change. And that's the point of the budget, right? So you want to kind of figure out your budgeting process so you can zero in on the things that you have control over, worrying about things you don't have control over, worrying about the fact that your rent's too high, even though you already signed a lease and you're going to be, you can think about moving next year maybe when the lease is up, but it is what it is at this point in time. That's not helpful if you're thinking about these items down here, either tightening or spending more. That's where your time would be worthwhile to put, not by worrying about it, but by actually planning and doing something actionable that might be, worth doing. So that's going to be the total variable expenses. Then we got the 4,500 minus that 3,009, getting us once again to the 6,000. So bottom line is, normally when you do accounting, you're going to have the income statement kind of in a two-step series. We call this a single-step income statement oftentimes, which would just basically be you're going to have your income and then all your expenses lined up. And you might then categorize your expenses by behavior over here more often, like utilities, clothing and whatnot. And then you might have subcategories of those expenses that might be more detailed, such as this is this type of clothing, that type of clothing, and so on and so forth. And then oftentimes in financial accounting, we will also then break out our information on the income statement into another format, which would be called a contribution margin income statement in financial accounting, or you can call it a flexible budget. So we can call it a flexible budget here, which you take that same information and try to group it by behavior of the expenses, those which in essence you have control over, those which in essence you don't, so that you can then focus in on those areas where you basically could have some control and might be able to change behavior and focus your energy where it would maybe do something.